I know people are not going to take this kindly, but I think old-time value investing was lazy and sloppy. I mean, you look at a PE ratio, invest based on that, expect to get rewarded. I think those days are done. I think you still need to think about value, but you need to think about it creatively. It can't be just through what did you make last year? What's your existing business model? You need to be open to the fact that business models are shifting, that there are companies that might not look good on a traditional value metric now, but are still good value investments. So I think if nothing else, it's a message to all of us that we can't just depend on the old metrics and get away with it because the world is shifting under us.
Most of us know this feeling. You've worked hard, saved some money, and now you want to invest it. But then you look at the stock market and it's overwhelming. So much noise, so many hot tips. And let's be honest, a lot of it feels like gambling. How do you make sense of it all? How do you invest in a way that's actually smart, reliable, and works over time? That's where Aswath Damodaran comes in. He's a professor of corporate finance and valuation at the Stern School of Business at New York University. Often called the Dean of Valuation, Damodaran is renowned for his practical and clear approach to investing. It's a way of investing that's grounded in understanding what something is truly worth, and then making decisions based on logic, not hype. His method value investing is all about understanding what a company or asset is really worth, and then investing in it only when the price makes sense. Value investing is like having a guide that helps you avoid costly mistakes and stay focused on growing your wealth in a thoughtful, reliable way. And the best part? It's something anyone can learn and apply. In this video, we're going to break it all down for you. We'll show you what value investing is, why Aswath Damodaran's teachings are so respected worldwide, and how you can start using these principles to take control of your financial future, whether you're a beginner or someone who just wants to invest with more confidence. This is for you. So, if you're new to our channel, don't forget to subscribe and hit the bell icon so you won't miss out on the valuable insights we share in our future videos. What value investing really means. Now that we've introduced you to Aswath Damodaran and the importance of value investing, let's first talk about what value investing really means. And it's easier to understand than it sounds. At its core, value investing is about buying something for less than it's worth. Imagine walking into a store and finding a high-quality product at a massive discount. You know it's worth more than the price tag, so you grab it. That's exactly the mindset you need for value investing. Damodaran's advice here is clear. Don't get distracted by promises of flashy future growth. Instead, focus on what a business is worth today. As Warren Buffett famously said, price is what you pay, value is what you get.
People think that Jensen Huang walks on air. I mean, he is at this moment, NVIDIA is considered the greatest company of all time. That's a dangerous place to be if you're management of the company, right? Because the expectations are you're a genius, you'll figure out how to deliver 50% growth from now through eternity with 60% margins. You can't do that. There will be disappointments. So if you lost the NVIDIA bandwagon, you never got on it, and you say, oh my God, that was an opportunity gone by, bide your time. It will be cheap again, but it will mean that you got to track the company, you got to value the company, you got to understand the company. And it can't be based on what other people are doing. You'll actually be buying when they're selling, when everybody's panicked. I mean, I remember when I bought, Facebook, I still call it Facebook, Metaverse after the fiasco. People said, what are you doing? Nobody likes the company. I said, but it's got an advertising juggernaut that's going to deliver tens of billions of dollars in cash flows. Why do I care that people don't understand or don't like the company? I'm going to get the cash flows. And you can tell me whatever you want about privacy or whatever other issues you have with Facebook, but as long as people show up on the platform and the advertising is there, I get my value.
If you're following Damodaran's approach, the first thing to do is focus on what the company already has. These are called assets in place. It could be things like strong cash flow, valuable properties, or a dominant position in the market. You're looking at what's solid and reliable right now. Growth is just a bonus. Think of it as icing on the cake. You don't want to rely on a company growing perfectly in the future to make your investment worthwhile. Instead, pick a company that's already strong, so any growth just adds to its value. For example, rather than betting on a startup promising to reinvent the wheel, you might invest in a proven giant like Coca-Cola, which already has a history of success and stability. There are different ways to approach value investing, and Damodaran breaks it down into 3 styles. First, there's the method of passive screeners. This involves using filters or rules to spot undervalued stocks, much like Ben Graham did. Graham had specific rules like looking for companies trading below their book value or with low debt. It's like following a treasure map to find hidden gems. Then there's the contrarian style, where you look at companies that everyone else is avoiding. Markets tend to overreact to bad news, so a company might seem worse off than it really is. If you're brave enough to go against the crowd, you might find opportunities where others see problems. Lastly, there are activist investors who don't just buy undervalued companies. They step in to make changes. They might push for a company to cut costs, restructure, or take bold steps to unlock value. Think of Carl Icahn, who's famous for actively shaking up companies to make them more profitable. So, whether you prefer analyzing solid assets, betting on market overreactions, or even taking action to fix a company, it's all about making logical, informed choices. And the best part? These strategies are something anyone can learn and apply. Up next, let's see how you can use these ideas to start making smarter investment decisions and how this strategy actually works in practice. How to spot undervalued stocks. When you're trying to spot undervalued stocks, numbers become your best friend. Damodaran emphasizes keeping it simple and focusing on financial metrics that really matter. For example, the price-to-earnings ratio and price-to-book value are 2 key tools you can use. These metrics help you figure out whether a stock is trading for less than it's really worth based on its financial fundamentals. It's like buying a house for half the price because you know its true value, even if the market doesn't see it yet. Ben Graham, often called the father of value investing, created specific rules to make this process easier. One of his famous rules is to look for companies with a price-to-earnings ratio that's lower than market standards. This means you're focusing on businesses that might be overlooked or underappreciated by others. But here's the catch. Not every cheap stock is a good deal. Some are cheap for a reason. Maybe they have high risk, poor management, or unstable earnings. So you want to focus on companies with strong balance sheets, low debt, and consistent performance over time. It's about finding value, not just low prices. Now let's bring Warren Buffett into the conversation. Buffett is one of Graham's most successful students, and he added his own twist to value investing. His advice is straightforward. Look for simple, understandable businesses with a strong competitive advantage, what he calls a moat. A moat is anything that protects a company from its competitors, like a well-known brand, a unique product, or loyal customers. Think of companies like Apple or Coca-Cola. They have such strong moats that it's hard for anyone else to take their place. Buffett also stresses the importance of investing in businesses with honest, capable management and earnings that you can actually predict. He famously said, "I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later, one will." Getting started with value investing doesn't require a financial genius or a huge pile of cash. Start small, but think big. Learn the basics: price-to-earnings ratios, price-to-book values, and dividend yields. And practice identifying companies with strong fundamentals that are priced below their intrinsic value. But keep in mind, not every investment will work out. Diversification is your safety net. It spreads risk and ensures that even if one investment falters, the others can keep you on track. As Buffett wisely said, the stock market is a device for transferring money from the impatient to the patient. Patience and consistency are your greatest allies. Finally, one of the smartest things you can do is learn from the best. Study the principles of value investing giants like Warren Buffett and Charlie Munger. Their discipline, insight, and strategies have stood the test of time. Read their books, watch their interviews, and soak up the lessons they've shared. As Damodaran often points out, the more you understand, the more confident you'll feel about making the right investment decisions.
Rather than call them items, I'm going to call them drivers. I mean, you might look at the past to get a sense of what those drivers are. You can look at, what other people are thinking. You can listen to management. Here are the three drivers for any business model. The first is growth. Now, how quickly are you growing? And for that, I think the place to go is look at revenue growth. Why revenue growth rather than earnings growth? Because you might be able to grow earnings even if your revenues are not growing by cutting costs or by playing accounting games. But to grow revenues, you either have to sell more stuff or charge a higher price. So that's the first driver. The second is you can get all the revenue growth in the world, but ultimately as a business, the way you're going to be able to be judged is to make money. So the second driver is margins. And when we talk about margins, we're looking at what kind of profits do you make on those revenues or expect to make. None of these drivers have to be today's numbers. They have to be, forward-looking numbers. So you got revenue growth, you got margins, and then you got to think about how much do I need to put back into the business to grow. One of the sayings I have in my class is growth is never free. So you're not an Excel spreadsheet. You can't just change growth rates from 10 to 20%. To grow faster, companies have to put money back. What am I talking about? If you're a manufacturing company and you want to grow, you got to build new factories. If you're a technology company and you want to grow, you might have to do R&D. If you're a user-based company like Uber or Airbnb and you want to grow, you might have to go acquire customers. So revenue growth, margins, and this measure of how efficiently you deliver growth basically can encapsulate any business model you see out there.
Next, after understanding how value investing works, it's important to recognize that while the strategy is powerful, it's not without its hurdles. Challenges to watch out for. Value investing sounds straightforward. Find undervalued stocks, buy them, and wait for their price to rise. But it's not always that easy. One of the biggest challenges is market competition. Every smart investor is out there looking for bargains. So the more people hunting for undervalued stocks, the harder it gets to find one. You're not the only person searching for a diamond in the rough. Another challenge is patience. Value investing isn't for someone looking to get rich quick. Sometimes it can take years for the market to recognize the true value of a stock. As the famous economist John Maynard Keynes once said, "The market can remain irrational longer than you can remain solvent." This means you need the ability to stay calm and stick to your strategy, even when others are panicking or chasing short-term gains. But it's not just about patience and competition. There are risks you need to watch out for. Just because a stock has a low price-to-earnings or price-to-book ratio doesn't always mean it's a hidden gem. Sometimes these low numbers are red flags. A company could be in a declining industry, or it might have serious financial problems. For example, think about businesses like Blockbuster, which had low valuation metrics, but was part of an industry that was rapidly being disrupted. Then there are costs. Every time you buy or sell a stock, you pay transaction fees. Over time, these can eat into your returns. Add taxes to the mix, especially if you're frequently buying and selling, and you might find that your profits are a lot smaller than you expected. So, what's the takeaway? Value investing isn't a magic formula. It's a disciplined approach that requires thought, patience, and the ability to look deeper than just the numbers. You have to dig into the reasons why a stock seems cheap and make sure you're not stepping into a financial trap. But if you're willing to do the work and stay consistent, value investing can be incredibly rewarding. All right, next, we'll talk about what makes value investing stand out from other approaches. After understanding its challenges, this is where you see why value investing has such a unique edge. What makes value investing truly unique? Value investing isn't just another investing strategy, it's a mindset. What sets it apart is its focus on contrarian thinking. Instead of following the crowd and chasing after the latest hot stock, value investors do the opposite. They buy stocks that everyone else has given up on. These are the so-called losers of the market. Companies that have taken a hit in public opinion or suffered recent losses. But value investors don't see these companies as failures. They see potential. Imagine a company that's been all over the news for the wrong reasons. Maybe its stock price has taken a nosedive after bad press or a disappointing quarter. Most people would avoid it like the plague, but a value investor looks deeper. They ask questions like, is this just a temporary setback? Could this company bounce back? If the fundamentals are still solid, this could be a great opportunity to buy low. Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. That's the heart of value investing. Another thing that makes value investing different is its emphasis on patience. This isn't about riding trends or making quick trades. Value investors are disciplined and willing to play the long game. They know it might take years for the market to recognize the true value of a company. But when that moment comes, the rewards can be worth the wait. It's like planting a tree. You don't expect fruit the next day, but you know the payoff will come if you nurture it. And then there's activism. While some value investors are content to wait for the market to catch up, others take a more hands-on approach. These activist investors buy into undervalued companies and actively push for change. Maybe the company needs to sell off underperforming assets or restructure its management team. Activist investors make sure these changes happen, unlocking the company's hidden potential. Think of people like Carl Icahn, who have built their careers by stepping in and shaking things up when companies weren't living up to their potential. Now that we've covered the core concepts and what makes value investing unique, it's time to get practical. And that's it. We've covered what makes value investing such a smart and grounded approach, why Aswath Damodaran's teachings are so powerful, and how you can start applying these principles to your own investment journey. If you found this video helpful, don't forget to hit the subscribe button so you never miss out on more insights about investing, finance, and smart money strategies. And while you're at it, give this video a thumbs up and share it with someone who could use a little clarity on their investing journey. Thank you so much for watching. Your time and attention mean a lot, and we're glad to be part of your learning journey. Until next time, stay curious, stay patient, and invest wisely. See you in the next video.